Hello, ladies and gentlemen. Good evening once again. You are very much welcome to the Annual Economic Review and Market Outlook webinar. My name is Isaac Opari-Noy. I'll be the moderator this evening. We're happy to have you join us as we share insights that will help you navigate through the dynamic investment landscape. To do this, we've arranged a lineup of speakers from our wealth management scheme, and their task this evening is to provide an overview of the business and then also share a comprehensive economic and market analysis. And they will deliver some projections for the year ahead so that as you think through, make plans towards your investment or your financial life, you will be guided. Each of the three speakers will be giving 15 minutes to present, and then the remaining time will be dedicated to answering all your questions. So we encourage you to put them together. You can share your questions during the session. You can use the Q&A tab, and we'll make sure every one of your questions is addressed. I don't want to talk too much, so I'll hand over to Nana Riafe-Boama to start. After Nana, we'll have a presentation from Gideon, and then Peter will crown it all. As I mentioned earlier, every one of them has 15 minutes to share with us. So Nana Riafe, please, if you can hear me, I'll hand over to you. Thank you.
Okay, thank you. Very much for the kind introduction, and good evening. And thank you for joining our Q1 2024 webinar. Before we go into the global market and investment outlook discussions, indulge me a bit to walk you through Access Wealth Management and what we do. I don't think I will need 15 minutes for that. So Access Wealth Management is a SEC licensed investment advisory firm. And we are a division within the Access Pension group. Right, the business has been built to offer our clients personalized and concierge wealth advisory services using only global financial products. Our client onboarding process begins with taking our client through our comprehensive financial planning process, as we can see in the next slide, Albert. And what is financial planning? Financial planning basically looks at how an individual or a family can leverage both their current and their future financial resources to meet their financial goals. So during our financial planning engagement with our clients, we help our clients figure out, for instance, their cash flow needs, their retirement spending needs, their children's college funding needs. We help them imagine their estate planning preferences. We help them, think through their risk management need and see, how we are able to help them leverage their financial resources to meet this varied client objective. Once we are done with our financial planning, we kind of help develop an investment policy statement that sets out the client risk tolerance, their goals, their return expectation, their risk preferences, liquidity need, just so they are able to meet their goal. Now, how do we build resilient portfolio for our clients? So the top 4 boxes encompasses our responsibilities, right, in helping our client think through their strategic asset allocation. And for us, strategic asset allocation is the most important decision an investor would make. And in thinking through our client strategic asset allocation, we ask questions such as how much equities or fixed income the clients will need in their portfolio, right, to be able to meet the objective, right? On equities, we discuss with clients what their preferences are. Is it developed markets or emerging market equities, right? When it comes to fixed income, how much would you want to allocate to treasuries? And how much would you want to allocate to sovereign papers, right? And the second area is tactical asset allocation, where over time we make short-term tweaks in our client portfolio to capture short-term opportunities. And then thirdly is how we implement our client strategic asset allocation. So how do we go about it? Do we use exchange traded funds, for instance, or singular securities in exposing our clients, to market. At Access Wealth, our preference indeed is using ETFs to build our client investment portfolio. Lastly, we don't take, for granted, the importance of maintaining ongoing communications with our clients every step of their way to ensure ultimate alignment, right, of their interest, and also to ensure that we are helping our clients meet their investment mandate and investment objectives. Now on to the next slide. We explain how we execute our client wealth mandate after establishing their strategic asset allocation. What we do over here is we use only third-party financial products managed by some of the world's best investment management firms to build our client portfolio, right? And in selecting, this product, we would like to state emphatically that we are very independent fiduciary, and therefore we go for only product that helps meet our clients' need. We do not have any commission arrangement with any of the providers of this investment product. What we use is our best effort, our love and passion, for market to develop, products and build portfolio, that meet our investment mandate of our clients, right? I know, few providers of this service in country who, are driven, by, commission, and therefore in selling, their advisory service or their investment management service, they naturally peddle the product that has the highest front load fee, ranging between 3 to about 6%. In our case, there is no, fee for accessing, global market, through, access. Again, I mentioned, our preference, for ETFs or exchange traded fund instead of singular securities in building, client portfolio, right? Now, what is ETF or exchange traded fund? ETFs basically gives investors, broad exposure, right, to basket of securities that makes up an index. So for instance, instead of buying singular companies in the, say, S&P 500, basket of securities, right? You can buy an ETF that gives you indirect exposure to all the 500 companies instead of, picking singular, securities. So our platform gives us access to every developed market and most emerging market, capital market, right? We thus have the option, to customize portfolio to, our clients, need and client time horizon, as well as the client return expectation. And we do that, using our model, portfolio, strategy. If we can move on to the next, slide. We prefer, to invest, our client capital in a model portfolio, right? Which are risk, graded and suited, to varied, clients, need and risk appetite. So for our typical risk-loving, client, and who is a risk-loving client? A client that can withstand, say, a 10%, drawdown in their capital over a short, time frame, and would even, love to take the opportunity to invest more. So for our typical risk, loving clients, the client that has long time horizon, the client that does not really need, portfolio, income to survive on a daily basis, we have our aggressive portfolio, which is tilted, 100% towards equity for, that need, of our clients. Again, for our typical, less, aggressive clients, we have our growth liquidity portfolio and our yield booster portfolio, that caters, to the low, risk need of, our clients. Again, this is what we do, and we do, better than our peers. You don't come into singular products. We try as much as possible, to build a portfolio of securities, right, that meet your risk, need and your financial goals. Now, we've had the privilege of running our services for about a year. So I would love to, share, our experience in terms of return across, our three, most invested model portfolio in the subsequent slide, right? So the last, three are our model portfolios. So the first is the aggressive portfolio, the second is the growth portfolio, and the last is our yield, portfolio. We have about 98% of our client assets invested across, these three, portfolio. Year to date, i.e. 2023, for our aggressive portfolio, we did about 17.29%. The growth portfolio did about 14.88%, and the yield did about 7.39%. If we are to transpose, the currency depreciation on this, dollar return, you'd realize, for our aggressive portfolio, the year-to-date return was about 62.47%, 59.14 for the growth portfolio, and about 48.77 for the yield portfolio. We are not the one, that would typically want to tout return, right? We were privileged and lucky, to start our business in 2023, when market, was good. What we want from our clients is the ability, to stay invested, with us for a long period of time, because ultimately, over a long time, capital market always, deliver, returns for clients. Also, the reason we prefer, to walk our clients through a comprehensive financial planning process is to understand their time horizon, first and foremost, before we invest. So if we meet a client who tells us that, Nana, I need my money in 9 months' time, to meet a liquidity need, right? We would invest in a product that has a time horizon of 9 months, such that when you need your money, you can have, your money without the volatility that comes with capital market investing. So we really want to understand you, your time horizon before we invest across any of these model portfolios or invest and build portfolio specific for your need outside of our model portfolio. To the next slide, Robert. All right, so how can we, help you, right? We are happy, to, work with you if, you are willing and able to commit $25,000, right? And this comes with complimentary, financial planning. We don't charge anything for our financial planning. What makes, our process, very, robust is that we manage, your capital through your own personal account, which is open in your name and custodied with our global custodian. So we manage, your money without having access, to your capital, right? And the good thing about the global custodian we work with is that, they have ensured every client account up to 30.5 million cedis. So you are, safeguarded operationally. Bankruptcy, will not, affect you. And bankruptcy of our global, custodian, partner. The only risk that we can, really, help you is market risk, right? Once you invest in markets, you are subject to market risk. If market does well, you do well. If market does poorly, you may do poorly. Our process is such that, we build a model portfolio and manage your capital through a model portfolio, right? And an underlying instrument we use are ETF, and that somehow reduces the potential risk or the potential market risk that comes with investing. So I am so happy, you made time to join our webinar. I will drop off the call, and then Gideon will take over and then walk us through what happened or transpired in market in 2023. Thank you.
Okay, thank you very much, Nana, for the welcoming introduction. So in this segment, I'm going to review some key economic indicators which have shaped our markets and will continue to shape our markets. On the next slide, This is an executive summary of the indicators I'll be taking you through. And in a nutshell, inflation has been trending down globally. On monetary policy, different regions seems to be at different stages of their hiking cycle. On growth, growth seems to be dispersed around and uneven. Some countries are growing strong, others are recording lower growth. And then on returns, market generally recorded a positive return in 2023. Moving on to the next slide. On global inflation is expected to decline to 6.52%. This according to the World Bank. And we already see key or economic regions recording declines in their inflation levels in 2023. If you look at the United States, inflation closed full year 23 at 3.4%, after peaking at 6.5% in 2022. If you check Eurozone area, inflation ended at 2.9% in 2023, as compared to 9.2% in 2022. And then if you check the emerging markets area, inflation, if you do an average, ended at 8.48% as compared to 9.77%, which hasn't been that of a steep decline like we've seen in the developed markets. The main factor that has been driving inflation downwards globally has been the general tightening, monetary policy tightening that we see. And also, largely for 2023, we saw commodity prices declining globally. On the next slide, this shows the trend of monetary policy across some developed markets and the emerging markets area. And if you look at the United States, for example, the graph shows how monetary policy had been being hiked to control inflation. Currently, we are at 5.5%. That's the MPC for the United States. If you check the Eurozone area, that has also been going through a hiking cycle over 2023. And if you check the emerging markets area, it's been the same, just that the hiking cycles seem to be different across, different regions. Some countries or some areas seem to be at the peak of their hiking cycle. Others have, across the emerging markets area, have even started easing or reducing their monetary policy rates. And so generally, monetary policy seems to be at the peak globally. Moving on to the next slide. This shows, the tightening we see ongoing reflects in GDP growth. And in the United States, or developed market areas, growth has been quite diverse. US growth has been strong. Third quarter was 4.9%. Fourth quarter growth did slow down, but it still did beat analysts or consensus estimates that it came in at 3.3%. Eurozone area did contract 0.1% as at third quarter 2023, and emerging markets did record about 1.15% with, varying growth levels across the region. And to touch briefly on the US growth rate, GDP growth, we see that wages, there has been high wages from tight labor markets, which is influencing consumer spending, and that plays a very critical role in, GDP growth in the US. Now, on the next slide, we are going to see how these economic indicators, which I have reviewed, have impacted markets. And on the equity markets, if you look at the various indices we have displayed here, that's the S&P, the NASDAQ, the Russell, indices that are accumulated across the EU area and emerging markets area, we generally saw positive performance across, these various indices, driven by positive investor sentiments across these markets. Generally in the third quarter, markets did underperform due to some investor sentiments and concerns about the rate hike cycle that is ongoing. Some people were predicting a recession, but I mean, markets did recover fourth quarter and did close the year on a positive note. Touching on the bonds market also on the next slide, generally fixed income markets also did record a positive performance for 2023, and this cuts across the various quarters that we saw, except the tracking for Africa, which the index excludes South Africa because of the concerns about economic performance and the flight to safety from Africa. Performance across, the region was quite bearish. But in the developed markets, fixed income markets were generally recording positive performances. That brings us to the end of, the economic segment, and I'll hand over to Peter to continue with market outlook and projections. Thank you.
Thank you, Gideon, for covering that section. So thank you once again for joining us on this webinar. I'm going to be talking about our market outlook and areas where we see opportunities going forward. So I'm going to start, if you can please get to the next slide for me, please, Albert. So looking at the various regions, overall, we're broadly bullish on the global markets in general, but we're more bullish in certain parts than others. Starting with the US, in spite of slowing GDP growth, we still see a lot of positive signs in the markets in general. We have had the very strong GDP growth for the year 2023. However, going forward into this year, we don't expect that strength to continue. We expect the GDP growth to slow a little bit. However, it's still going to be positive. So we don't expect a recession per se. However, markets are a little jittery because they think the Fed is trying to do something that has never been done before, which is achieve a slowing economy by increasing rates without triggering a recession. But all signs point to the fact that the economy continues to hum along really strong. A lot of strong positive signs out there, and so the chances of avoiding a recession are very high, and that keeps market sentiment really high. So we do expect the economy to continue to grow due to the fact that interest rates are going to be coming down. With inflation has come down from its peak in the summer of 2022 through last year, end of the last year. Inflation was down to Gideon's earlier point, around 3.3 for the quarter, way better than expected. We also see unemployment at very, very low rates. So still below 4%. We've never had a recession in the US with unemployment below 5%. And so the Fed has a lot of room, to maneuver before unemployment becomes a big concern. We're starting to see, a lot of, layoffs being announced, but job openings continue to be strong. And we think that consumers will continue to have, the spending power to continue to spend. We think that as long as people have jobs, the economy is going to continue to grow. The consumer sector makes up about 70% of total GDP, and so being the biggest part of the the whole equation, if the consumer is in a strong position, then it's likely that we're not going to have any recession here in the US. So those are the main positive signs as far as the US go. However, the early signs or potential risks of recession is that the economy is slowing we're seeing increased earnings, increased layoff announcements, and then corporate profits and earnings, have not been so overwhelming in this reporting season. And so those are things that, we keep an eye on. However, we're still very optimistic on the broader US market. When it comes to the Eurozone, it's not as, bullish as the US. We think that the inflation continues to be high, more persistent than here in the US. And so that is affecting the growth of the Eurozone dramatically, making it difficult for the ECB to start cutting rates. Whereas here in the US, we expect the Fed to start cutting rates at the latest in May. Markets, some are expecting it to start cutting in March, but we're thinking it's going to be more in the second quarter than in the first quarter. Whereas in the Eurozone, the Fed is not close to cutting rates, and so the rates are going to remain high for quite a bit longer. Although valuations are very attractive in the Eurozone, there's a lot of potential, problems in that area. So we're very selective as to where to invest in the Eurozone. But in a broad sense, we are optimistic in advanced economies, with the US and Japan being the favored regions compared to the Eurozone. As far as emerging markets go, we are optimistic in the emerging markets as well, especially areas that are benefiting from reshoring, and diversification away from, China. A lot of economies are diversifying away from, China, which had, been the world's manufacturing hub for decades. But after what happened during COVID and supply chain constraints, a lot of economies are trying to avoid, a repeat of that. And so there's been a lot of reshoring where big countries are bringing back manufacturing to other parts of the world. And some of the areas that are going to benefit from that trend include India and Brazil and Mexico in Latin America. So that makes, parts of emerging markets very, very attractive, and other areas may not so much. So on the whole, the global economy is expected to continue to grow with, unemployment low or coming down, inflation coming down, and GDP growth still in a positive trend. Next slide, please. So where are the investment opportunities in these various regions? We talked about moderating inflation as some of the factors that make the US attractive. Inflation has come down from its peak of 9.6% to the most recent numbers, which came out last week with the Fed's preferred inflation numbers coming in at 2.6%. So it's getting close to the Fed's target of 2%. Interest rates have come down from its peak of around 5% to below 4% recently. And that has made fixed income attractive again. It's also made, tech and growth stocks very attractive because of, valuations. So when rates are low, it makes the valuation of some of these companies, more attractive. We're also seeing unemployment, coming down, still below 4%. That makes the US continues to be attractive. Like I said earlier on, it makes the consumers, have a strong position, because once you have a job, your ability to spend, is really high and strong. Corporate earnings, have been strong, although, not every sector is doing well. Companies continue to beat earnings expectations. So some of the tech names that reported, some are reporting 33% increase in earnings from the previous quarter. So corporate earnings are continuing to be strong, although not every sector is experiencing the same phenomenon. The big caveat to the US market is valuations are kind of stretched up a little bit. And so PEs are kind of high at this point. And so it makes, investing very, very active at this point. We're not gonna have a situation where, you know, a rising tide is going to lift all boats. You have to be selective as to what companies to invest in. And so we believe in high quality, strong balance sheet companies, companies that have, you know, the fortitude to weather any potential downturn. And then also companies that, you know, are still beating, you know, earnings expectations. So if the PEs are stretched, the companies have to report strong earnings to justify such a high PE. And so that's why it makes sense to be actively investing and not, you know, just be passive, investing in a broad sector or broad markets. When it comes to developed international, like I mentioned earlier on, the Eurozone is slowing. It's still suffering from high inflation compared to here in the US. Although valuations are very, very attractive, that requires even more active investing because there's still pockets of opportunities there, but you don't want to be, you know, broad markets as far as, you know, Europe goes, because the broader region is still, you know, having challenges. But there's, you know, few areas that are still doing well, and you have to be very, very selective. The areas that we favor outside of the US is Japan. Japan has very, very strong monetary policy that is helping, you know, the economy to bounce back, and they also have, you know, relatively attractive valuations. And so Japan is preferred in the developed international region outside of the US. When it comes to emerging markets, like I said, the reshoring theme makes industrial sector very, very attractive because a lot of companies, a lot of you know, regions are bringing back manufacturing, you know, to their shores, and so that makes, you know, investing in those areas very attractive. Valuations also favor emerging markets. P's are very, very low compared to here in the US. India and Latin America are some of the favored, you know, areas in the emerging markets. China has, you know, really not done well recently because of the trade tensions with the US, but also their response to COVID and how long it took them to come out of that was not very helpful. The other challenges in the Chinese market is the fact that they currently have a very, very high unemployment rate, especially amongst the youth. And so consumer strength has been weakened. The other issue with the Chinese market is for the second year in a row, they actually had a declining population. And so the number of, you know, the number of deaths actually exceeded the number of births in the Chinese, you know, market. And that was the second time that has happened. And so long term, you know, they have, you know, a lot of demographic issues that could come back to haunt them. Next slide, please. So with all this being said, the sectors that we really like in the US market in general are, you know, the tech space, specifically we like semiconductors and anything to do with AI. But tech in general continues to do well. We also like communication services due to still on AI theme. Comm services is one of the sectors that is going to continue to do well. Comm services used to be part of tech, but it was broken out in the S&P a couple of years ago, so it has its own niche, you know, sector. So those two sectors are our top, you know, favorite places to invest. Next will be consumer discretionary. To the earlier point of consumers being in a strong position due to job markets still strong, job openings out there, low unemployment. Consumer discretionary is one of our favorite sectors. And more specifically, within that space, we like housing due to the shortage of housing in the economy. So the demand for housing continues to be strong, and due to the fact that rates, you know, were at historic highs, people were not selling their homes to buy newer homes. So it's been a very, very low inventory environment as far as existing homes go. So the only way for new home buyers to get homes is new construction. And so we've been very, very bullish in the housing markets as far as home builders go. They've done really, really well. And we think that demand is going to continue to be strong. And it's going to be even stronger when rates, start coming down. So we expect the Fed to start cutting this year, like I said earlier on. And if the Fed, cuts 3 or 4 times, it's going to bring mortgage rates even lower, and that's going to, fuel the housing demand. Areas that we underweight to at this point is utilities, real estate, and staples. The trends in those sectors have not been very encouraging, and so those are areas that we've been kind of avoiding. And then one space that we are kind of neutral on is the energy space. We like energy due to the fact that there's always demand for oil, and the geopolitical tension going on in the Middle East at this point, is likely to bode well for energy space. If there's any escalation, it's going to affect the supply from that region and drive up demand. That has not played out yet, but we think that long term energy is another space that we are optimistic on. We're not overweight to it. We just kind of even with the market's weight at this point. So that brings us to the end of my part of the presentation, and we'll stick around for any questions and answers.
Thank you very much, Nana, Gideon, and Peter. That was a very insightful presentation. We would like to straight on moving to the Q&A section of this webinar. And I would like to start with Gideon. And Gideon, I have a question here for you. So somebody wants to know, in the light of everything that is happening, what do you think is going to be the city's performance instead of forecasting? So by the end of this year, what do you forecast to be the cedi exchange rates at the end of the year? And Gideon, please, you're muted.
Okay, thank you very much, Opari.
Sure.
So when it comes to the city's performance, there are a lot of factors that drive it. Currently, we are on an IMF program, and we just received some inflows which seem to boost our reserve position and give quite a stable outlook. But if you look at what has been happening historically, the city has been more tilted towards depreciation. Even though we have, received inflows from the IMF, mind you, the central bank has been able to suppress demand for, the dollar. And so what we are seeing now in the system, we are not operating at our optimal, or let me say normal level. And that's how come we seem to be experiencing that stability. But should things go as normal, we are likely to close the year with some mild level of depreciation. There are still, some downside risk, to the city's performance, and so yes, there's some stability now, but there are some, risk also against the city, and so largely I would peg it at we are likely to experience some form of mild depreciation.
Thank you very much, Gideon. Just a follow-up before you called on maybe for Nana and Peter, but we also want to remind you that you can continue to share your questions. We have received a few of them, so please share your questions with us so that we'll address all of them. Someone is asking that's okay, anonymous. Given that inflation is trending downwards and the fact that T-bill rates are high, would you recommend investing in T-bills locally?
Okay, that's an interesting question. So let's look at the reality on the ground. Government doesn't have access to, let's say, the domestic and international capital markets to borrow funds. And so the treasury bill market remains the only source of funding for the government now. They have given all indications that that side they are not going to touch when it comes to restructuring. And if you look at it logically, they can't close the only avenue they have for sourcing funding to run governments. And so for let me say default or restructuring, I would peg it at a very low probability. And to the question of investing in treasury bills now, that seems to be the only avenue available locally to a lot of people. There are other avenues that people may not have looked, but the investment team I would like to close with and sound very high here is we all have to be watchful of diversification. And you can invest, but make sure that your portfolio is well diversified. And it's not bad to invest in treasury bills, but people have to open their eyes to other opportunities also. Thank you.
Thank you very much, Gideon. Nana, would you want to add something to this?
No, I think Gideon has captured,
Okay.
everything. But what I'll say is investment, really should be goal driven, right? Historically in Ghana, we've chased rates, right? We've invested, because government is either offering, the highest rate, or some investment company out there is offering the highest rate. We go in without due cognizance of why we want to invest. So you should ask yourself, what your goals are, right? If you have some short-term goals and you want to invest, to meet, those short-term goals, we all know treasury bills, would offer you that liquidity. That liquidity because either 91 days, 1 to 2 days, 1 year, you get your maturity. So you can tie, the maturity against, your goals. But then if the objective, is long-term, then you would have to consider, all the economic factors at play, locally, right? So a friend of mine did an analysis on the performance, of treasury bills, right, over the last, 20 years. If you had invested in treasury bills over the last, 20 years, your nominal return over that 20 years is about 7,000%, which looks, awesome, right?
Yeah.
But then you convert it to real return, and your real return over that 20-year period is less than 30%, right? Dividing 30 by 20, you are making less than 1% real return. So
Yeah.
we are advocating and preaching for goal-based investing, where, you invest according to your goal. So to answer yes or no will be difficult on this platform, but this is a conversation, we can have. If your time horizon and your goals, align with an investment in treasury bills, why not? But if you are looking at something, far off, the future, we would want to, consider some of the political and economic, forces at play, locally. Thank you.
Thank you very much, Nana. Peter, I have a question here for you. So in recent past, we've heard a craze about digital currencies, and somebody wants to know what are investment prospects in that sector, i.e. digital currencies are.
Oh, thank you for the question. So digital currency is an interesting phenomenon or asset class, I can put it that way. The issue with that space is it doesn't produce any cash flow. And so it's hard to value them. It's hard to quantify what the return is going to be. It's mostly speculation driven. And so there is sometimes there's a fear of missing out. We see the price going up and people want to, be able to capture some of that return, so they invest in it. But to actually project how it's going to do in the future, it's not something that is doable because it doesn't produce any cash flow. And investments are based on what the cash flow is for that particular investing, and then you discount it back to present with a rate of return. The risk factor. And so that's the issue I have with digital currency. That's not to say that it doesn't, it's not worth investing in. You can use it as a way of diversifying your portfolio. It can be used as a store of value, just like you invest in currency. Some people invest in currencies, right? And so
yeah.
you can invest in digital currency as a store of value and as a way to diversify your portfolio. but you cannot do it as an asset class which is going to produce or generate cash flow. And so, you can value it. That's what I can say on digital currency.
Thank you, Peter. There's a question related to this, and I think it's maybe from the explanation you were giving. Somebody's asking that what are the other types of instruments that you would recommend? So, instruments that have long-term and then also strong returns.
So that's there's multiple ways to answer that. It all depends on the individual situation. There's so many asset classes, but depending on the risk appetite, when you're talking about long-term returns, one area that has consistently, done well over the long term and been a very good hedge against inflation has always been equities. Okay, so the equity market continues to do well. It continues to trend high in spite of all the volatility. If you have a long time horizon and you have the patience and you're not going to be cashing out at the wrong time at the bottom of the market, and you stay in for long term, your chances of experiencing good long-term returns are really high. But with that being said, all depends on the individual's risk appetite. Not everybody's comfortable with equities, right? But if you're comfortable with equities and you have a long-term horizon, you don't have liquidity needs in the immediate horizon. That's what I would recommend. And the other thing I want to add to that is at this point with everything going on, we're emphasizing high quality companies. So companies with strong balance sheets that will be able to, deal with any, short-term market volatilities. If there is any like credit crunch, it's usually companies with strong balance sheets that, come out strong. One of the companies that I continue to respect that we like very much is Apple. So Apple has managed its balance sheet so well that they actually benefited from high interest rates. And so they issued a bond at like 1% when rates were really low. And they've been able to, invest in treasuries when rates were high. So they're actually making money on their money markets, than they're paying on the bonds that they issued. And they have billions of, dollars in cash on their balance sheet that they can use to buy other companies. So no matter what happens in the US economy, we're likely to see Apple continue to thrive and continue to grow. Those are some of the companies that we continue to invest in because they have a very strong balance sheet. But long term, equities is what we recommend. Fixed income, depending on which part of fixed income you're looking at, is also a good asset class on a long term basis. So it depends on the individual's risk appetite. But those are the two, broad areas that, long term, you're likely to, make some good returns.
Thank you, Peter. I'll get back to you shortly. So Nana, there's a question for you here. What are the challenges of offshore investments and what are the strategies to overcome them? Somebody wants to know, please.
Okay, thank you very much. So, good question. The challenges with offshore, investment from the Ghanaian, perspective, right, is volatility. When I say, volatility, when we onboard you, you have access to a portal where you see all your assets which have been purchased on your behalf, right? Every day you go into your, investment, right? You see, movement. It could be red, it could be green, right? And I know, most Ghanaian investors are not accustomed to mark-to-market. It became a phenomenon, last year, right? So we advise you, as Peter, mentioned, to trust the process, right? You definitely have a reason why you are investing. And once, your reasons are clear, right? We get to understand, how much resources, you have, how much risk you can take. We tell you to ignore the, volatilities. So the challenges are market risk, right? Opportunities, are enormous. They are enormous. Like Peter, mentioned, if you had invested, in Apple, when Steve Jobs, returned, to Apple after, he was, sacked, right? Your $10,000 would be in excess of $1 million, right? If you had invested in companies like Monster, Energy, right? In the 90s, right? Your 10,000 dollars is in excess of 20 million today, right? If you had invested in Tesla, right, your 10,000 will be multiple of hundred of thousands of dollars today. And we are here, crying wolf because Atlantic Lithium are down here, exploiting our resources, and we are getting very low royalties. No problem, right? They are going to use that to manufacture their Teslas and the electric vehicle. You can also go and invest in their Teslas to enjoy the benefits. So the opportunities are enormous. The challenges, market risk, your principal can reduce, right? However, if you have the staying power, you have a long time horizon, the probability of making money is almost 100%. Thank you. I don't know if Peter, can he is based over there. He's been doing this for all his career. So Peter, if you can touch on that briefly.
And so as far as, you said, almost all of it from the perspective of the Ghanaian investor. What I can add is that, the risk of investing offshore is, apart from the ordinary market risk, I think that it actually works in the favor of the Ghanaian investor. And so, if you're talking about exchange, so investing outside of any jurisdiction, right? The two main things you want to think about is exchange rate risk and political risk. Now, if you're investing in a country like the US, where the dollar to cedi rate is usually, favors the US dollar, and you're investing in the US, then that actually enhances your local return in the US, in Ghana. And so the foreign exchange or exchange rate risk actually favors the Ghanaian investor. The other risk will be political, risk, where, if for like a US investor investing outside, they'll, add to the required return they'll add a premium to the required return because of investing in a region that may not be considered as stable as the US. Now, for the Ghanaian investor investing in the US, the US seems to have a more stable environment in spite of its, problem. It's still not a perfect place, but it's more stable. And so, I think that offshore investing for the Ghanaian investor, I think that apart from market risk, there's little to no other risk to be worried about apart from market risk, because things will actually work better in your favor. Inflation here in the US is more stable, compared to other parts of the world. And so your $100, for instance, that you invest in the US market is likely to maintain at its value, if not beat it. And so at the end of the year, you're not going to have your $100 now worth $50 due to hyperinflation. So those are certain areas, certain things to look at. But apart from that, I mean, speaking from where I sit, I do not see any specific risk that will prevent me from investing. If I was living in Ghana, investing in the US. So I hope that answers your question, but that's how I see it.
Thank you, Peter. Just a follow-up. So somebody wants to know, is there a possibility that offshore investments can be locked up with no access to it? So beyond the risk you mentioned, is there a possibility that it can be locked up? You can't have access to your funds?
I am personally not aware of any situation like that. As long as the broker-dealer is a well-established broker-dealer, which is regulated by FINRA, and the custodians are taking care of assets under management, I don't know. I don't see the reason why they will lock up any investments unless there's some illegality going on somewhere. If the investor is on some kind of OFAC list, or they've been blacklisted, by the government for, terrorist activities or money laundering or something of that nature, yes, then your money can be locked up. But if the sources of the funds are legitimate and you are, a legitimate investor, trying to just, invest legitimately for your financial goals and for your family and all that stuff, and you're not trying to finance any illegal activities, I cannot think of any reason why your funds will be locked up here in the offshore market. So Nana, I don't know if you want to add anything to it.
And then, also in terms of liquidity, if you satisfy all of Peter's, condition, right? Developed market are the most liquid market, out there, right? It takes a fraction of a second to execute a trade, right? Once a trade is executed, and the cash settles in your account, and you want, your cash, in Ghana, you get, your money within 24 hours, right? So we've had, clients who requested, for their money, and they were overwhelmed, how fast, they got their money. And like I mentioned, this is a private, wealth, thing. So you are the only one who can enter into your account, make a deposit, and make a withdrawal, right? We only trade on your behalf, but in terms of movement of funds in and out of your account, you're the only one, who has, the power and authority, to do that. So locked up fund, Peter have, mentioned it, in terms of liquidity, when you want your money, after investing, it's as liquid as water, if that is a good expression. So thank you.
Thank you very much, Nana. Gideon, this one is for you. So given what Nana and Peter has said about investing offshore, somebody wants to compare that with investing in real estate locally. So given the current market risk, what would you suggest? What would be your answer to that person?
Yeah, I'm sorry, Gideon, I'm sorry for jumping in, on this question, but I'll give you the fight. I told you, for this, business, our biggest, competitor, I keep saying, is real estate, right? Any, Ghanaian who has enough, money to invest is thinking about real estate. And why real estate? Because they feel, they can preserve, value over time. But then I would say, if real estate is what you want to do your hard work and compare, return over the period. And we've had, the privilege of working with a number of clients, right, in this business, numbering about 40. Most of them have real estate holding. And the highest rental yield I've seen on, our client real estate, holding is about 2%, right? 2% is the highest. And you can't compare, 2% to average equity returns, right, of 10% plus. If it is growth you are looking for, right? Even if it is income you are looking for, you can't compare, 2% on the dollar to about 4%, 5% in safe, high quality, sovereign, paper. So that is just my bet about that. Gideon, please, over to you.
Yeah, so Nana is very passionate about, real estate. And to add to what he has said, I think we should look at, this whole thing from, a broader perspective in terms of an entire portfolio. Most often people get into real estate, and when you look at, when we do financial planning for them, you realize that their assets are really concentrated in real estate. Real estate, we should note, are illiquid investments. And these investments we are talking to you about kind of gives you, enough liquidity, whilst, it also gives you enough cash flow. From a cash flow perspective, that's what Nana said. If you go into real estate, people go into it hoping that they would get more capital gains. If you actually compare the cash flow from rent, or real estate, the rental yield, against the entire investments and what you'd have, gotten from investing in some of these financial assets we are talking about, I think the financial assets we talk about offer, a very good benefit or prospect for investors. So real estate is not bad, but looking at it from a broader perspective, you have to be watchful because it's illiquid and it can also give you lower, yield than what financial assets will give you. Thank you.
Thank you very much, Gideon. We want to still encourage you to keep sending your questions in the Q&A section. And Nana, please, this one is for you. Somebody wants to ask about tax and investing offshore. So his question is that given the current tax regime in Ghana, where amendment to tax laws have made it like taxation global for Ghanaian citizens, what do you think the framework will exist given if he wants to invest offshore, and how GRA would deal with this? Thank you.
Well, thank you very much, for the question. So yes, we've done a bit of reading on the taxation implication of investing offshores, but we are not, tax, expert and tax advisors. So ultimately, the words, of the tax expert will prevail. What I know is from my reading, I don't think we have those double tax treaties, with, our counterpart in the US or some of the developed markets, we invest in. So when you sell your investment, for gains, again, I doubt if, GRA, would have, overview of your brokerage account. As a responsible, citizen, you would have to go in and then declare that I bought, Apple stock for $500, I sold and made an additional 500. So what tax is applicable, to me, right? So you pay, your tax as a great citizen. Over there, the platform we use, takes care of all your US, tax needs, right? And the reason we also use ETFs, they are basically, a bit tax efficient, right? Otherwise, income that is made in the US is taxed at around 30%, right? If I'm right. And then for capital gains above 1 year holding period, you pay 15%, and anything lower than 1 year, you pay 30% capital gains. But locally, you would have to, walk into the GRA, file your tax return and declare all the incomes, you've made outside of your normal, job, your side gig, your investment, offshore, and then you pay. Thank you.
Thank you very much, Nana. Peter, so somebody wanted a clarification. I think when you were answering the question about the various investment options that you would recommend, you touched on stocks, and somebody wanted to know if that is what you like, that is confirmed, i.e., what is the outlook on interest rate, and do you think that he should buy or hold stocks currently, at least in the next 1 year or two?
Yeah, so like I said, all depends on the individual's risk appetite. But in this environment where rates, are going to, started coming down, we expect the Fed to start cutting this year. When rates are low, it favors equities really well because valuations tend to go higher. And the areas that do even better are the growth side, versus value side. But my points with equities is that, equities long-term have been the best hedge against inflation long-term. Fixed income is good, if you are in retirement or close to retirement, and you need liquidity like really, really soon. However, depending on what the yield on the fixed income is, it may not be beating inflation. Okay, so depending on what jurisdiction you are in, even if you're being paid, 5% a year, you have to be cognizant of what the inflation rate is. And so if inflation is at 2 or 3%, then your real return is about 2%. Okay, whereas with equities, if you have the risk appetite for it, the Nasdaq was up over 40%, last year. S&P was up about 24% last year, just in 1 year. So in spite of the fact that, equities are very volatile. They continue to trend up, over the long term. And if you have a long-term horizon, which is any time around maybe 3 to 5 years, some will say 5 to 10 years. But if you have a long-term horizon, it makes sense, to invest in stocks if you have the risk appetite for it. You don't need a liquidity now. And so I cannot give a blanket, answer as to what asset class to invest in. And that's why, you have a team like ours that can have a one-on-one discussion with you, look at, your situation. Also depends on what other investments that you have. So we do a comprehensive financial planning to have a clear picture of your entire financial picture, and not just hey, we can recommend buy this amount of stocks or X amount of bonds. We need to see the whole picture, what other asset classes you have, and build a comprehensive financial plan for your situation. But I will say that in broad terms, in general, equities have been the best hedge to inflation in the long term. So
Thank you very much for that answer, and thank you very much to our facilitators for giving us such insightful presentations and even answers. As we draw close to the program, we'd like to invite Nana on behalf of all the facilitators to give very short remarks, and then we can bring it to a close.
Okay, thank you very much, Opare. So, briefly, we just want to appreciate you all for making time, to join this call, right? It's end of day, and I guess, we are all in a hurry, to go to our families. So we really, appreciate you so much for taking time, to join us on this call. It would be a pleasure, to work with you over the next, coming days, right? To help you with, first and foremost, a comprehensive financial plan. Like I mentioned, that is free. That is, free pro bono, right? And then once, we present a plan to you, if you want to advance discussions, because you are looking for opportunities, to diversify, your wealth, right? And the whole reason we are here is diversification, right? Do not put all your eggs, in one basket. That also goes for, country and currency diversification. Don't put everything in one jurisdiction. We are happy, to work with you and to diversify, your assets. So thank you very much, for joining us, and thank you, Opare. Thank you, Peter. Thank you, Gideon, for a great, job done. Right.
Thank you, Nana. Once again, thank you very much for making time with us. We encourage you to speak to advisors to discuss any questions you may have after this engagement. And please don't be in a hurry to leave. A form will appear, so that before you exit, kindly leave your contact details so that we can reach out to you to address any specific needs that you have. And by way of announcements, in April of this year, we will come your way again with another webinar on estate planning. Estate planning has been a big elephant in the room for a lot of people, and we have a very insightful webinar coming your way again. So please mark your calendars in April. We'll communicate in due time with the full details. I want to say a very big thank you for joining us this evening. Enjoy the rest of the evening. Have a good day. Thank you.
thank you.
Thank you.
And please, when you exit, so the form will either appear when you exit. So as soon as you exit, the form will appear, and then you kindly enter the details for us. Thank you.